Good afternoon, everyone. My name is Baldev Binder. Thank you for joining our webinar today on trade finance. We are giving this webinar from our offices in Singapore with Blackstone and Go. And we've got a great panel today to join us. This webinar is for an hour. And a few house rules that I wanted to put across before we start the webinar. One of the things would be that the views that are expressed here naturally might be controversial views. I would say these are views that are personal views held by our speakers. They are not views of their companies that they work for. So in any case, if don't attribute these views to their companies, to put it that way. We will try to get past the webinar within 45 minutes to allow a 15-minute slot for any questions that you guys might have. Feel free to put your questions into the chat function at the bottom right of your screen. Let's start this webinar proper itself. Now, I want to set the context of what we're doing, and before we start the session, let's introduce our speakers. I'm really delighted to have some of the speakers join us today. They are experts in their fields from a variety of sectors, including lenders, traders, fintechs, and platforms. They are very much at the cutting edge and very much immersed in trade finance and some of the issues that we're seeing today. So I'm just going to introduce our panel quite quickly. We have Mr. Palaf Muna, who is from Louis Dreyfus Company. We've got Mr. Nick Moore, who is from EFA Group, who has kindly stepped in for Francis' daughter, who unfortunately has unable to make this session at this time.
Good day, all.
We've got Mr. JP Kuta from Income Land.
Hi, good afternoon.
We've got Mr. Kelvin Tan, who is a co-founder and chief investment officer of GTR Ventures.
Hi.
And lastly, we've got Mr. Luis Guterres, who is part of Liquid X, a platform community that has been set up, which I believe he will explain more about. Gentlemen, thanks for joining us. Feel free to unmute your mics. Let's start with setting the background for why we're here today and where we are with trade finance today. So everyone would have read that ABN AMRO is winding down their commodity trade finance book. SocGen is moving their book out of Singapore to another country, to Hong Kong. Various banks are looking at commodities trade finance, whether they want to do it. The reason for this really is because of the numerous cases that have hit, particularly the Singapore courts, but in other parts of the world as well, with allegations of trade fraud, double financing, and invoice fraud. Now, from my perspective, I've been doing trade fraud for years. None of this really surprises me very much, but to the larger trade finance community, I think there are concerns over the validity of trades and over how we do trade finance going forward. Two themes, from my personal point of view, come across in all the cases we've worked on. One is leverage and trying to understand leverage, and leverage of a borrower. In large part, it seems to me that financial statements need to be relooked, the reliability of financial statements. Also, this issue of leverage crosses both from the point of a lender, but also from the point of a counterparty when you're trading with them. You need to understand the leverage of the trader, how leveraged they are, because as we've sort of are learning from some of these cases, the pursuit of liquidity is never ending. That's theme number one. Theme number two that arises from this would be the constant problem of double pledging, which is a recurrent theme that's gone on years and years and years. Double pledging is just one of the methods to achieve the overall objective of liquidity. So if I could set the scene as to where we are here today, the fact that there are parties that are exploiting information gaps, exploiting fragmented chains, and that's how they are, you know, I call it the land of the blind. That's how one person can actually, a one-eyed man can actually lead everybody else in this land of the blind. A lot of it is fragmented, a lot of it is not seen. And I want to start with Kelvin to set the scene for where we are today, and particularly to describe is this retreat from trade finance that we're seeing. Is it, number one, sensible? B, is it a Singapore problem? What are the weaknesses you see in the current system for trade finance? Calvin, over to you. You'll have to unmute your microphone. Thank you.
Thanks. Hi, everybody, and good afternoon from Singapore, and to those dialing in from overseas, maybe good morning or good evening. They chose the guy without the jacket and by the beach to start, so I shall be making brief remarks. Thank you, Baldev, for putting together a great panel. I wouldn't call myself a trade finance expert because obviously the experts are before you. All I can share is from my very short experience, both in trade financing from a regulatory point of view, now from an investment point of view, investing into the future of trade, which presents opportunities that counter the weaknesses that you just mentioned, i.e. fraud and risk. And finally, from my earlier days when I was a child or a baby, you know, when I started my career in the Ministry of Trade, where I recall that I was so proud, you know, as a young officer at the Ministry of Trade negotiating a free trade agreement with India. And I was all proud. I gave him my first name card, and then he said, yeah, but Kelvin, you know, all these things, legalities and stuff aside, there's always ways to circumvent. And my uncle was a trader, full on, right? Not that he was indulged in fraudulent activity, but trade always finds a way to make the world go round. Fraud or no fraud is always risk-laden. And I think that weakness that you mentioned about that has always been around. It's just whether, in accordance to the flavor of the month or the years, whether banks or regulators choose to accept or look at it. When I joined the MAS in 2016, it was full-on fintech innovation. We were at the debut of the Singapore Fintech Festival. Trade finance out of Singapore by the 1,000 banks that we had was the bread and butter in the transaction banking department. And it was at about $1 trillion Singapore dollars. Now, that is three times our national GDP. And today, your question is, with the retreat of ABN and some of these commodity trade finance banks, will that volume shrink? I think yes and no. Yes, because certainly, you know, some of the traders that are not robust enough in their systems, they will have to go under, or they will have to consolidate. No, because alternative lenders such as Income Land, that's going to speak later on, and many of these alternative trade finance funds that are still emerging and finding their sweet spot will continue to fill the gap. The gap today, you know, is global trade today is about 18 trillion. It grows from year to year. That juice that powers trade is 18 trillion. Will it drop by 1 trillion? Where would that gap go? You know, in fact, there is a gap by the ADB that says it's 1.5 trillion, and then if you look at the SME trade finance gap, it's 5.2 trillion. So I think these are some of the big pictures that sets the tone.
Sure. So you're suggesting somebody else will pick up the slack?
I think somebody else will pick up the slack, and if we were to call it as I don't see this as a bailout for trade finance, just like how regulators have bailed out aviation and airlines, right? But if this is a bailout that commences with the word B, then I would say backstop is a more appropriate word. A backstop that needs to be activated right now from regulators and multilaterals aside to unlock the liquidity that de-risk so that trade can continue. So I don't see trade stopping, and I don't see trade finance stopping.
Understood. And I think the spotlight then will be on lenders. What lenders should do, their due diligence. And there are two types of trade finance, the way I see it broadly. You've got asset-based, where there's an actual trade that you're wrapping yourself around in terms of lending. And then you've got this creature called the revolving credit facility, RCF, where it's let's call it loose lending, where money is given, and as long as you pay back quickly, it's a revolving doors. Nick, I wanted to take this to you as a lender. How is the risk profiling different when you're dealing with asset-based financing and when you're dealing with RCFs?
I think to mix the two is not quite in the same bucket, right? The RCF is primarily a cleaner vehicle. You're looking at trade finance, and then there's financing trade. So I don't think you should be jumbling the two up, because RCS tend to rely on the credit standing of those corporates, and you're relying a lot more on the matrix of their credibility. Whereas trade finance, there is an implicit assumption that you are ring fencing what you are financing. You are taking security around those assets, and you are capturing the sales proceeds to repay yourself. To try and mix the two, it shouldn't be done. I mean, I think people need to go in as a lender. You need to go in with your eyes open. What exactly are you financing, right? How exactly are you financing it? I think what has happened is over time, a lot of lenders have said they're doing trade finance, but have cut certain corners, allowed copy BLs perhaps, allowed LOIs, allowed against financing against MIPS receipts, or allowed financing against warehouse receipts, allowed financing of receivables without it being duly notified and acknowledged, and without the caveats of set-offs and counterclaims. So it really, it's a spectrum, right? So the true sense or the true nature of trade finance by right should have had all those bells and whistles. Yes, they can be fraudulently made, but when you have all those bells and whistles, the opportunities for fraud start to get limited.
Why do you think that is so then? I mean, this cutting corners, is it an issue of time pressure? Deals have to be done quickly? Is it an issue of margins? The margins are so thin that you cannot factor in a robust due diligence approach? Or the third one, sorry, is it an issue of technology? Which I doubt so, but I think the technology definitely is there.
Primarily, I think it's the corporate or the borrower demands, right? They're saying, look, it's too troublesome, I can't afford to do it. And with competition, then banks start to maybe pull their pants down a little bit more and a little bit more for the larger corporates, because they are waiting to garner that much portion of that business from the larger trade. So that's the evolution, right? I'm willing to sacrifice a little of control just to get access to that size of business. So when competition was heavy, that's where they headed towards. And the timing, obviously, to tick all those boxes, or to make sure that the structure has all its bells and whistles, it will take more than 1-2 days to sort all those things out before you can do a disbursement. Whereas borrowers will come in and say, look, I need that drawdown today. I need it today. So then what do? Do you say, sorry, we need to go through those checks? Or do you say, okay, let me try and accommodate? And then that's the evolution, right?
And how do you compare them? How do you compare yourselves with guys like IncomeNet, fintechs that can upload invoices, just assess invoices, and then disperse? I'm talking about fintechs in general in a matter of hours from what I hear. Some of them can do it in hours. JP, what do you think in terms of, because we're talking about volume and how the volume work and the margins have led to some of these corners being cut. In your business of receivables financing, invoice for financing, how can you guys, or how do you guys do it better?
Yeah, well, I'd like to think that we're not cutting corners, although we're a fintech. And for me, it's really about knowing your customer. At the end of the day, although we're a fintech, although we have a platform, we have a technology, it's still a relationship-based business. And any new relationship we have, we spend about 4 to 6 weeks on average onboarding a new customer. So sometimes people think, okay, you're a fintech, I'm just going to upload a new transaction and you finance right away. This is not our business model. We still do our KYC and we do our KYCC. So we would like to know who is our customer's customer, who ultimately is going to pay that bill. And we do our KYT as well, know your transaction. We want to really understand the whole supply chain. So yes, technology can be leveraged to do some checks and due diligence that it's a legitimate transaction, and I think we're going to expand on that later on. But for me, at the end of the day, it has to be about knowing who you're doing business with. The fintech guys are not just cowboys, in my opinion. I mean, just Louis and I we're the two guys wearing ties on the panel, so quite professional, huh?
I was going to say, know your customer, Pallav. That's your know your customer equals know your counterpart as well. That's very much part of your business, right?
Very much so. So again, I think building on to the questions which you brought up and some of the panelists like Nick and everyone have pointed out as well, right? Leverage of a borrower. How do you calculate the leverage of a borrower? Double pledging of, okay, is there a concept called double pledging? Technically, you can't pledge your goods more than once. Okay, so if there is double pledging, you're talking about a fraud to start with. Second thing, leverage of a borrower. Leverage, most of us, when we look at the financial statements alone, the financial statements are as of a particular date and given to us by the borrowers. If someone is out there to commit a fraud, I am a firm believer of the fact that they already know what are the tick boxes that you're looking at, what exactly is the story that you're looking at. They will build all of that and fancier. Okay, one interesting observation which came up was this notice of assignment. Okay, how many people do that? The acknowledgement of debt, because in the recent spate of cases, what we've been hearing is that there have been a lot of fraudulent transactions. Does anyone really want to get caught with their pants down? But if you don't do it, others are all doing it. So you do it or lose it, kind of a thing. So ultimately, it all boils down to knowing your customer, knowing who you're selling to, trying to engage with them. But again, I'm a firm believer of the fact that if someone is out to perpetrate a fraud, all your due diligences and everything go for a toss.
Let me take 2 points. 2 points with that. Your first one is know your customer, right? But we've seen in a lot of these cases, we're talking about long chains that are being made. They're being made for the very purposes of actually distracting, diverting attention, and exploiting information gaps. That's why you have 10 different chains. In the business of commodities trading, and I imagine lenders increasingly will want to say, or will say that I want to see their entire transaction. I want to see who is your supplier buying from, who is your buyer on selling it to. How realistic is this in your business?
I personally think that, okay, each business will be unique, but I don't think anyone would want to go ahead and tell you the entire chain, right? At best, you can ask your customer, what is your business model? Who are you buying from and who are you selling to, and what is the commercial logic of you doing it? I don't think anyone will enter into any piece of business without there being a commercial logic to it. But they may be restricted, or they may be only able to tell you, or they would only like to disclose to you what is their business sense. So basically, you have to understand the business and little bit deep digging, and that's why know your customer and understand where and how they make their money. Understood.
But knowing your understanding the commercial role played by each party, the commercial position, that when it hits the fan, and when people like us, when the lawyers start looking at it, then we sort of uncover and think we can't see a commercial role. Where if you're looking at a transaction that you're looking to do, and you are not convinced with the commercial role of your counterparty, would that be enough to sort of jettison the whole or eject from the whole?
Okay, so to start with, if you're not convinced of the commercial role of your counterparty, I don't think any of us here would want to even get into a transaction, right? And when you as a lawyer look at it, shit has already hit the fan. So you have a lot more information which was probably hidden or masked from any of us, any which way. And again, you spoke about leverage, right? So many of the customers or buyers would want to kind of manage the leverage as a particular date, for which they may be willing to pay a particular price. So you have to understand the underlying logic. And again, while you understand the business, not everyone is fraudulent. It's just that coincidental right now, too many of these newses have been, or too many of these cases have come back in quick succession. And the timing and the economy generally is not helping as well.
Understood. So I have the $1 million question for everyone in the panel. But I'll let Lewis, it's actually a difficult question. The $1 million question is how do you prevent, minimize, or mitigate this issue of pledging the same BL twice, taking the BL today and going to bank A and saying, you know what, I can take the same BL and go to bank B and get double the money. Kelvin, perhaps you could start off with that actually.
I think we tried at the industry level once back then to solve the issue of not just double pledging but multiple pledging, because the accuracy is actually multiple pledging of the same receivable. We tried, obviously, because it was fashionable at that time, and it still is quite fashionable today, to use blockchain as a use case technology to solve multiple pledging. We found that the issue with that was mass adoption for it to be really, really effective. So I think suffice to say that short of using a common platform where lenders and traders can come together and share information on an efficient way without the risk of the DLT ledger being tampered, I have not seen any other technology sets that can resolve this issue. It is a tough issue to resolve, and I just want to put it out there because it partially answers as well what someone asked: how does one KYT if the assets are to be on-sold to unknown buyers down the line? Again, it depends on how you tag the asset. If it's oil, obviously it's very difficult, but if it's something that can be taggable, then it can be given a blockchain identity, and then information sharing can be done in a more anonymous fashion, and then you know if that invoice or that BL has been pledged. I think that's a short answer, but I think I just wanted to put it out there. Everybody knows this concept, and then I invite discussion with the audience as well on how this can be better resolved given today's context, because obviously it's not being resolved in the way that we want.
One of the things that actually Baldev has been posting intensively in LinkedIn is the need of a central registry of charges or pledges, which I believe actually it could be a good first step. In other countries they are doing this, like for example in Australia they have a registry for pledges over livestock, which is connected actually to the radio frequency tag of the animals that they are wearing in the ears. So basically the financiers can actually monitor where the exact asset that they are financing is located in one specific at one specific time. But it's more complex than that, because Singapore can create this registry, and I believe that it will be a good first step. But trade finance is, especially in Singapore, is transnational. I mean, Singapore is not producing anything; it's just a trading hub. So it will be a good first step, but then the countries around Singapore, they will have to actually do the same, or at an ASEAN level, or something like this. I believe that further steps are required, and yesterday I was reading some news that the China Banking Association is co-building jointly with the first biggest banks in the country, blockchain-powered platform where the banks will be able to interact for trade finance products. So basically, I think the first step will be for LCs, and they will have visibility over the entire chain. But it's a first step. It's only in China, but I believe that also this is the future. Basically, it will this technology will provide a lot of real-time visibility to the financiers, and not only to the financiers, also to all the counterparts that are involved in the chain.
And isn't it better? I mean, the exploitation that's being done right now is that party A doesn't know party C. Different people don't know their counterparts, their subsequent traders on selling to traders that they don't know. And I would think a platform like LiquidX, with its hopes of actually bringing everyone together or creating a marketplace to bring everyone together, would that go towards addressing some of these problems?
Yes, indeed. And I mean, actually, it will work for many of the counterparts, also for the insurance as well. The insurance companies will be able to actually monitor as well. They will able to give their inputs and confirmation that, I don't know, this asset is insured or not. It could be useful for as well for the customs, collateral agents, liners, and even for the companies itself, because with the blockchain technology, you can actually integrate this technology not only with the softwares that the banks are having, but with the treasury management systems that the companies are having. So it's also, from a treasury management point of view, quite good for companies that are having, I don't know, thousands of invoices being paid every day.
Understood. So interoperability between different systems, because the blockchain technology has been around for a long time now. It just hasn't taken off, or adoption hasn't happened as much as we hoped it, for many different reasons, but interoperability is one of them as well. I'll put the same question on to Nick and JP as well about this, about a central registry. Is that going to help this double financing problem? If not, what else can help?
Obviously, the devil's in the detail, right? But if there was a blockchain where everybody subscribed to and everybody was participating in globally, that's the sweet spot. The reality is there are all these parallel blockchains that are going on right now, and everybody wants to use their own. A central registry would be very helpful, I think, in Singapore's context, to dispel or to sieve out the genuine players from the non-genuine players, and also change the narrative around traders in Singapore, right? Because if you can establish within the country and within the borrowers incorporated in the country, a means of validating where your BLs are, and everyone has access to that Singapore borrower, and they know that, okay, they're pledging it. That'll be very good, because then it basically seals out those naughty, fraudulent players, because they're not going to be wanting to disclose what's on this registry. It would not be. They would be called out. The biggest concern, of course, is these BLs are very fleeting. So the methodology of how you register this is going to go on and off and change hands very, very frequently. So conceptually, it's a nice thing to think about. I just think practically, that's something that we really need to discuss. How can that be done? How can you claim as a lender at any point in time that is yours? That process is going to be something that we need to brainstorm around. But obviously, that would be beneficial for the trade and for Singapore and for lenders.
Correct. I'm just going to take a question that we've asked is whether on this issue, whether it's possible to have a centralized BL registry where all BLs are available. And I wanted to add that the IMB about 2 years ago started a house BL registry for freight forwarders to put their BLs on a voluntary basis. And I don't know the success of it, but the fact that it's voluntary should already tell you that how difficult it is to get someone to put their BL onto a system. And then there's a question of the person who issued the BL, and only one person can issue the BL. Everyone thinks it's somebody else, but only the ship can issue the BL. By the time it goes on the ship, to the freight forwarder, to the agent, to the trader, to his buyer, 5 hands have touched the BL, and each hand that touches the BL increases the risk of duplication, exploitation, and fraud. And I want to go back to JP on this, is when you're doing invoice financing, how much of the emphasis is on the BL? How much is on the emphasis on the actual trade that goes on? How do you tie the invoice to the trade?
It's a combination of both, Baldev, and this is why it's really important to know who you're dealing with and to understand the transaction. So if I'm financing leg A, I want to also have visibility to leg B. I want to be able to rebuild the trade and see the contracts that are tied up to this BL. So I'm financing that invoice. Okay, the buyer, who is he selling to? Is he selling to one of the parties that I see on the BL? So it's a manual process, quote unquote, although we have technology solutions in-house. All of the transactions we do is buyer disclosed, so the buyer has to confirm that the invoice has been assigned to us, so they are legally on the hook to repay us. And there are a lot of efforts being done to make this process as smooth as possible for our customers, because at the end of the day, we're a fintech and we want to distinguish ourselves from the banks or the typical lenders. But to build on what Lewis and Nick were discussing, there are a lot of good efforts that are being made into a central registry and having a blockchain, but the issue is that it's driven by the private sector. Unfortunately, I think until it's driven as a legislation, people are just going to participate on a voluntary basis, right? We have our system, LiquidX has their system, but the two systems don't speak to each other. So I feel that as a group, we probably know everything, but info is money, right? Info is very valuable. And yes, we share information from time to time, but there's no such thing as a central ledger that is mandated currently.
So Kelvin, who should be
actually
sorry.
Yes, sorry. Actually, technologically speaking, I mean, it's possible. It's possible that actually our systems they collaborate and they interact. I mean, currently the hyperledgers are flexible and allowed to integrate and operate with other platforms. So I agree with JP that actually if there is a push from the public sector to share more information, I think it will be very, very useful.
Kelvin, the question I had was the push for legislation. Should it be Singapore-centric? Should it be led by the people like IMB? Should it be more translational? Should it be more regional, for example? Where should we start?
I think we should try. We should look at the hub and spoke approach firstly. So we should target the trade hubs, right? Singapore, Hong Kong, where trade financing is being done. That's one. Number two, I think if we talk about the Singapore context, where all of us are more familiar with, the incentive from the public sector to turn this into a central registry has to be one premised on a public utility approach, where the registry is built stack upon stack from very simple instruments that verify and de-risk to very complex instruments like LC, BL, cross-border kind of stuff. So whatever any regulator, whether it's Singapore or whether it's Hong Kong or whether it's UK, whatever within the domestic that it can control, is already a good starting point. Over and above the cross-border piece, if we look at an invoice that today is driven by the PEPL standard. PEPL is an electronic version of an invoice that is widely used in Europe, and Singapore is driving that through the INDA. That alone forms a good base to be put into a chain or a registry of sorts that can be linked partially to ACRA information, for example. We don't need complete blocks of information encapsulated in a digital invoice or digital ACRA identity. The beauty of technology, and I'm sure Louis and all the technology players out there can attest to that, is you just need to take a hash or an ID, an ACRA number, for example. Let's say you take a UEN. You combine that with the unique identity of a PayPal invoice, domestically issued and non-manipulate, cannot be manipulated, right? You combine that ID with the PayPal ID, you combine that with dates, for example, and an IMO number, which is unique to every ship if it's a cross-border. Just 3 elements combined, we create a unique hash that it's a stamp of validity on how it is unique and not manipulable, right? So starting with that, then you move on to other building blocks, like collateralization, customs, broker agents, and so on and so forth. So I think I think the authorities, I don't speak for them, but I think if any of them are in this audience right now, this is certainly, we can perceive this as a call from the industry for the public sector to look into this a little bit further.
Yeah,
I think it's great. I think it's great advertisement for Singapore as well, and the robustness or the improvement and robustness on how it governs its trader community within the country.
So speaking of genuineness along the BLs and everything, right? So typically, most of us at some stage or the other do use IMB reports, either us or the banks, to see whether the shipment is genuine or no. But what the IMB report actually tells you is that, okay, this ship actually docked at this port, is so much was loaded, and it's destined towards this particular destination. Now, if they can go one step ahead through regulators or through shippers or anyone, saying that, okay, this is the shipper, this is consignee to order, or this is a specific buyer. And then as and when there are changes along the chain, that is also necessarily registered. So at least the person who is financing a BL, or once a BL is shown, you can, when you go to IMB, see that, okay, this is the new shipper indeed, and this is the new buyer. So at least that will help you in that much. I think that could probably go a long way as well.
Yeah, so I was going to ask you about that. If I show up today, wanted to do a trade with you, wanted to sell a cargo, I give you a BL. The only way you can verify this is to perhaps check with the IMB that such a transportation, such a voyage actually went on. There's no way you can tell that that is my cargo. No way, correct?
So what happens is, many a times the piece of paper, like you said, you have multiple. So there's no concept of multiple pledging. It is basically fraud. The moment you have pledged anything beyond the first one, it is a fraud. So which means that there are people who are issuing BLs which look genuine, but they're changing certain details and making it look genuine. So that's where, so again, when anyone does an IMB vessel check, they will probably just know that, yes, there is this cargo which is moving from point A to point B, and it is carrying this kind of goods.
Understood. We've spoken quite at length about double pledging, and that's the second point that I brought up in today's seminar. The first one was actually about financial statements, understanding leverage. It's a brave new world now, I think, especially for lenders, because you will have financial statements, the perfect balance sheets put forward in front of you, and I think now we've increasingly, it might not say, or it might not mean what it says. So Nick and JP, in terms of financing, in terms of financial statements, what's your take on it? How reliable are they? And if they are not so reliable, what can you do about it?
JP, you want to start with that?
Yeah, sure, I can take it. Thanks for thanks for you being so kind. Well, the reality about that is that the accounting standards, the way they're designed right now, and I'm gonna build on my CFA background here, is that they simply don't understand the notion of supply chain financing. They cannot account for reverse factoring and all those fancy financial engineering that is our bread and butter for the people on the seminar today. But I wouldn't be surprised that months from now, if not years from now, they will adapt IFRS or GAAP, and they will force companies to divulge those type of facility, those type of supply chain financing that is like you mentioned, it's off balance sheet, so you don't have visibility on it. And it's not only in commodity trading; it's across all industries. And we've seen several cases in the past months and years whereby it was very difficult to assess how leveraged a company was. So the way we look at it internally, as when we do our due diligence, is we look at certain metrics, right? Without giving away our secret sauce here, operational cash flow is very important to us. The profit is very important. We look at several ratios, and then we establish, well, how much limits are we comfortable with basis that framework, and then we look at transaction per transaction. And I'm going to be boring, and I'm going to repeat myself, but it goes back to knowing your customer and monitoring your customer. So you know your customers at the beginning of the relationship, but then also you have to monitor. You don't have to become complacent with a customer, right? You have to see changes in behaviors and repayments and dialogue with the customer. Nick, do you want to build on that?
Yeah, no, I mean, that was what I wanted to add on. I mean, fundamentally, financial statements are at best 6 months old, you know, and it doesn't tell you where the situation of the counterparty is today. Looking at how they've classified it, it's all under IFRS, and they can be clever in the way they classify assets and liabilities. So going back to your point, JP, at the start, it's knowing your customer, knowing what they're doing, understanding their transactions, knowing the counterparties in the industry. So you can, you know, there are warning signs when you see certain counterparties in their AR aging reports. There are warning signs to understand why is this counterparty particularly dealing in this commodity. That a trained eye can identify, and you say, no, this is, you know, you can tell me what you want to tell me in your financial statements, but I'm going to add this as debt. This is debt, right? A lot of the times you see advanced payments, and they come in and they're receiving those kind of funds. Then you can say that should not be. It's not a trade payable. It's debt, right?
Sure.
So it goes back to that understanding. You know, going beyond the numbers. For our business, we need to understand the robustness of the balance sheet, obviously. Where is that equity? Is it really genuinely equity? Or is it just loaded with non-payment assets, non-performing assets? You know, what is your equity stack? What is your equity actually comprising? That's just fundamentally what we want to understand. But at the bottom of it, once you've had a general comfort around the counterparty from a financial perspective, financial statement perspective, what are you financing? To leverage is to effectively say there is an asset side of that leverage. How am I getting my clause on that leverage? How can I properly wrap that? I think that's critical. So, and that goes back to the essence of trade finance, right? If I'm really doing trade finance properly, that's what I need to make sure as well. Not just how the balance sheet looks, but how can I get security?
So I was looking at some of the questions, and some of them are very interesting, right? So some of the high-profile frauds that we've had have had multiple banks involved, multiple players involved, and each bank, one would assume, goes through at least 3 sets of eyes, if not more, before approving a credit proposal, right? And these guys have been in the business for a long time. So many years, personnel change, top management engagement, everything happened. But I don't think anyone smelt a rat. At least, otherwise people wouldn't have been caught with these kind of exposures to start with. So financial statements looked good, the business model looked good, but then it just comes to where is the tipping point? When they start thinking that, okay, they're doing X million of trade, which is genuine, and they get tempted that there are other options and avenues available where they can start raising funding using other sources. And that's when you really lose sight of where exactly the transactions could have gone wrong, right?
I like that phrase, tipping point. You're right, because I start out as a small SME. I trade with my friends. I do a brick and mortar business. I make some money. Life is good. I'm moving cargo. I get richer. I mean, I get more successful. And then at one point, I think I'm going to go into the business of leveraging, and I'm actually going to start creating receivables due to me so my financials look good so that I can borrow more money from the bank. And then I'm stuck in this addictive circular scheme for liquidity. And I have to keep going. I have to keep producing more and more of this. The question to the outside world now, the difficult question is, how do you identify this? How do you identify at what point has the person tipped over to become not a trader anymore, but to become a financier of sorts?
I wish people knew this, right?
I mean, that's an interesting question, Baldev, and I think if you look across the stratosphere of names that have gone down in the last, call it, year, you will see there's a common factor. They are at that tipping point. They are those SMEs, they are the medium-sized enterprises that have grown to a level where banks are now seeing them in a different light, and these corporates have potentially exploited that tipping point because they could, right? So you're seeing that. I think the larger players who've had the established infrastructure to and the internal punitive measures to make sure that these kind of things don't happen, you don't have that for the SMEs that have grown to a level that also sort of start to get access to the same kind of capital, and that's where the problem starts.
Good point. Good point.
I think I just want to add, if I may, a couple of keywords here. I think in commodities trade in particular, the margins were much better back then. Today, it is so thin. Therefore, a trader-to-trader deal is almost a circular financing thing. And if I'm a lender today, I wouldn't lend to a trader that then on sells to another trader, because I don't think there's enough margin or enough skin in that transaction to justify that asset changing hands, through 2 or 3 traders. So I think one consequence of this retreat in terms of liquidity from the market will be the squeezing out of medium-sized traders to smaller-sized traders who used to survive on that arbitrage. I think they'll be wiped out. I think that's one safe conclusion. I mean, if Trafigura and some of the big names that we're used to can't even squeeze out decent, 150 bips from crazy, leverage prepayment deals, with African copper tailings, I mean, how do you do that with a trader-to-trader kind of deal? I just don't understand, right? So I think that trader-to-trader to multiple trader thing is going to be thrown out of the window. I just want to throw in 2 other things. I think we did not address the issue of trade-based money laundering, which is important, maybe less important to a lender, because as long as the margins are there, we're okay to turn a blind eye to it. But I think the issue of over and under invoicing is also critical to look at in the whole scheme of fraud metrics, right? Because it does have a role to play in financial statements, like inflating the sale so as to get more financing. I think that practice as well, there needs to be some kind of a check as well. Yeah, I just wanted to throw in these few comments.
Thank you.
I agree with Kelvin. I really believe that actually many third-party financiers are going to be wiped out from the market. And yeah, I just wanted to add that actually these third-party financiers are not a surprise as well for the financiers. I mean, everyone has friends in the industry, in banks, in alternative financiers. We know who is doing what, who is a third-party financier. We don't know to which level, but we know who is doing this and that. And the thing is that financiers for many years, they have been financing these companies because they were giving you a nice yield. So it's really not a surprise that actually, this company is doing paper trading. I think the financiers also were blinding themselves and saying, okay, I believe that this company is managing well the risk, and also they have some financial robustness and enough financiers in case, in a worst case scenario. So this has been in a way allowed in the market.
I have a slightly different take on this. Okay, so while Kelvin, you're saying small trader to trader business will not last, I think there is some logic as well. So sometimes I'm talking about the mid to small ones as well, right? They come in because they are in places like Singapore, Dubai, Hong Kong, which are financial centers who have huge trade facilities, and they provide some kind of financing. So basically today information arbitrage does not exist as such. Okay, it's about financial arbitrage. So these guys have the capability of borrowing at lower cost, and trade financing on a back-to-back basis or a front-to-back basis does give you that value. And if they sell to countries where the cost of interest or cost of financing is higher than a place like a Singapore, Hong Kong, obviously it makes sense. So, I mean, to paint everyone in one brush will probably be too generalistic. And again, it boils down to what kind of due diligence can you do. But with all due respect, I think the names which have gone bad, there wasn't any inkling in the market. Otherwise, so many people wouldn't have been caught the way they have been caught. Things can go wrong, right? So if people are out, and that brings me again to the first point, if people are out with negative and wrong intentions, there is nothing that we can do sitting here discussing. They'll find loopholes around the system.
I slightly disagree with this, because from my point of view, when we study trade fraud, it doesn't seem to me that someone has set out from day one to do trade fraud. It doesn't seem to me. It seems to me they were doing the trade business, and then they thought, you know what, I can make a bit more money by moving financial docs here and there. And there's always a bit of an intention to get the money back and to pay it off. It's a short-term liquidity game that they're doing and hoping to get it back. And when liquidity is sucked out because there's a micro event or macro event, then it topples.
No, I agree, Baldev. So it's not that the intention was to defraud the people to start with, but eventually, like you said, tipping point, right, in my earlier comment also,
yeah.
When do you reach that tipping point and what happens? And then they start fabricating. So they already, I mean, the intention to start with was never to defraud. It's just eventually, probably it led to something of that sort where it became too big for them to handle.
Understood.
And the main issue here is not that I think when it gets to the stage that we see defaults, it's not at the stage where these corporates have decided to do it for profitability purposes. They are doing it for survivability because their business has grown, they're unable to cover their overheads, they've made certain losses, and they need to cover up. That's effectively what happened. And going back to Palla's point on the receivers, yeah, there could be interest arbitrage between traders in different countries. But I think that's where, if you're providing credit to a trader, that's where you have to be wary, right? So if the buyer is a trader, where is he getting his source of repayment? Is he distributing? Okay, does he have a good distribution model? If he's just a trader selling on onward sales terms that he's also offering credit, it's a domino effect, it's a domino problem waiting to happen, right? And that's where that due diligence is also coming into play, right? If you're seeing, oh, these guys, it's a local entity in Vietnam, I'm giving them credit terms, but what are they doing with that money? Are they distributing themselves? Are they the operator? Or are they also on selling at a higher interest rate to somebody else locally? And if these guys default because the prices have collapsed, that's it. Half a card falling down, right?
Yeah, who's going to pay the bill ultimately? Where's the money going to come from at the end of the chain?
That's true. Some concluding remarks, guys. I think we've got 2 or 3 minutes left, and I wanted to just quickly speak about technology and how it seems to me that, you know, Bank A doesn't talk to Bank B, and that's why you can exploit getting financing from 2, 3, or 10 banks if need be without each other understanding how much financing has been given. What role does technology have with this? Can the fintechs plug that gap? Can someone like LiquidX, and, you know, is that the step in the right direction to say this is now, we are putting a community together, we are trying to be as more transparent, provide more information on a consolidated base so that exploitation of fragmented gaps cannot happen? I
think this is the future, to be honest. And I think that in this current situation, financiers and also regulators are looking at what are the benefits of blockchain. I think it can be complemented with other measures like the central depository of charges or some others. But yeah, I think it will take some time because there is as well a fragmentation of technologies, and these technologies right now are being developed in order to interact with each other. But this is the direction. I think this is, from my point of view, is the future. Yeah.
For the rest of the panel, should we not make life more difficult for people that issue fake invoices? Should we not put them in jail?
I want to say that technology is an enabler
Yes.
of an intent. And this intent, whether it comes from community, meaning us and those in this forum, or those from the regulatory side, it has to be a joint intent. It cannot be just an intent from this community of guys talking about fraud and nothing is being done on the public sector side. So community-based policing on a voluntary basis, I'll just put it out there, doesn't work. Therefore, whatever technologies you throw, blockchain or whatever, doesn't work. You need that community-based intent coupled with a signaling effect from the authority. This signaling effect can be legislation, which is a hardcore brush, or it can be something else that is in between. I do not know what is the range of possible policy options, but it has to come together. And then the technology will enable all this. That's my take.
Yes, yeah, absolutely. And Baldev, I think, yes, we should make life a bit more miserable on these guys, because at the end of the day, it's a few bad apples that make the reputation of this asset class a bit controversial, right? And if we can get rid of that 2-3% of bad apples, then yeah, that'd be fantastic, because those cases are the one taking 95% of our time, right? And 95% of the media and the publicity on the marketplace. There's still an asset class that has been proven and still has its space in the industry.
One point that I'd like to just highlight is I think we need to be clear whether we are doing trade financing or financing trade. And what I mean by that is, if we are doing trade financing, then let's live up to its name and do it properly. I think you have to. You need to be very clear what you're doing and what kind of risk you are taking. When you are doing an RCF, when you are doing financing against less tighter structures, you are actually taking credit risk on the counterparty. So don't cry when things go sour, right? If that's the case, then that's the decision and that's your analysis that you've done. But if you intend to do it on a really structured trade finance basis, then stick to the basics and ensure that you have the BLs, the original BLs that work, and do your due diligence against who's the shipper, who's the owner of the vessel at that point in time. Maybe that means you have to go into the CP analysis, go and look at the charter party itself. If I'm covering inventory, have a CMA, have the pledge. I mean, yes, it's expensive and it's time consuming, but that means that you are one step less from getting defrauded, right? If you, likewise in the receivables, yes, if it's too complicated to get the assignment, accept the fact that this is a clean lending on receivables, unless you really want to wrap it and make sure that buyer is going to pay you without set off and counterclaim. That's what you need to be clear. And then if you're not doing that, accept the fact that there is a clean element to it, and it's a spectrum, and live with it. I mean, that's something that I think you're trying to mix. There were people in the market right now trying to mix the two.
Understood. Gentlemen, I am truly honored to have your views expressed over here. I think to wrap it up for the session, there are a few, if I could summarize our views, I think we all recognize the need for more transparency. In what form that transparency comes, whether it's in the form of a registry, whether at the very minimum of putting something on ACRA to say that your BLs have been pledged, a central registry, a registry controlled by IMB, a blockchain-enabled registry control pushed forward by the government of a certain country. All of these are different options, but I think we all agree that transparency on information would actually enhance and facilitate trade growth going forward. There are different issues that arise from that as well. That's in terms of managing risk, but also we've got to make the reward and risk structure a bit more balanced. Trade fraud should not be done, any decision to do trade fraud should be taken with the gravest of consequence, I would think. So I think the sanctions for forging an invoice and so on should be enough. I mean, in the Singapore way of saying it, should be enough to put people off doing it in the first place. So I think that leaves us with a good analysis of what the market is, and in terms of our outlook for what the market is as well, what is missing and what we hope to plug in this gap, whether being on a traditional basis of trading, or on the legislative policy side, on the lending side, and also in terms of technology at the same time. Gentlemen, I thank you at the bottom of my heart for a delightful session. I thank the audience for attending our session as well. We've come to the end of our hour. Thank you, everyone.
Thank you.
Very much, guys.
Thank you.
Thank you. Good
Thank
evening.
you.
Bye-bye. Bye.
Thanks.
Bye.
Bye-bye.
Bye.
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 Thank you.